Hi, and welcome to Swissquote's Daily Market Talk. It's Wednesday, November 5th. A decent wave of selling hit major US and European indices yesterday, triggered by nothing other than the good old worries that are being cited every day and everywhere since months now. The US dollar, on the other hand, extended its gains against most majors, whereas gold failed to attract those running away from the risky assets. So we will talk about what all that means and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. And so the market mood got hammered yesterday for all the reasons we've been citing over and over since months: overstretched tech valuations, an increasingly narrow rally in the market, and the circularity concerns around big technology companies that are reviving dot-com bubble comparisons. Add to that the fading dovish hopes for a December rate cut from the Federal Reserve, signs of a weakening US economy, lingering inflation risks due to tariffs, and the thickening fog as official US data remains elusive due to the US government shutdown, and you've got a recipe for unease for investors. Yes, but the sour cocktail of all the things that I just cited didn't prevent major US indices or the European indices from rallying to uncharted territories since April, and there is no certainty whatsoever that yesterday's sell-off will be the beginning of a broader market sell-off that will shed 10 to 20% of the valuations in the coming weeks. It is a possibility, a reasonable possibility, and it is very much expected by many investors out there and big company CEOs, including big bank CEOs, but it is not a preset cause because counter arguments exist. Earnings are better than expected for the S&P 500 companies. The Fed may not cut rates by another 25 basis points come December, but it will end quantitative tightening. The latter will bring extra liquidity to the market, and the latest data shows that the Fed is already adding liquidity with reverse repo operations. And the People's Bank of China is also back to purchasing bonds to support the economy, while the AI deals are also coming in, latest confirming that Nvidia is now looking for more deals outside the US borders. The latest deal being announced with the Deutsche Telekom from Germany, and the company didn't say its last word for this earnings season just yet. So yes, the latest news and the bearish market reaction to strong big technology earnings call for caution. The VIX index is rising as an additional sign that the level of stress among investors is rising as well. Then the 13F filings also show that the big shorts Michael Burry is now short the AI champions. Apparently, 66% of his portfolio is in Palantir puts and another 13.5% is in Nvidia puts. But hopefully all this doesn't mean that apocalypse is ahead of us. Now, I am saying this because before we move on, when I was a younger analyst, say a decade ago, don't try to guess my age, well, I have been watching the market and commenting indices, and I actually kept calling the top 4 years until one day, a person from my audience just came up and said, hey, stop being persistently bearish because this is not how the markets behave. And he was right, and since then I actually learned to somehow swallow my bearishness and look at the markets from a more realistic perspective. More realistic, not necessarily more reasonable, but more realistic, the one that suggests that the stock markets do not necessarily reflect the underlying fundamentals, and the markets and investors' behavior to news and data is more complex than rational. And truly, this rally will probably bump into a wall, and we will probably see that 10 to 20% downside correction that many expect, but then it will be an opportunity for buyers to buy at discounted prices, and the game will simply continue. So with this being said, the S&P 500 and Nasdaq fell at yesterday's trading session as a sell-off after Palantir's record and better than expected results failed to bring in more buyers, and the latter triggered the fear, the worries that the technology valuations may have gone ahead of themselves, with the price to sales ratios now for these buzzy technology and AI plays having gone obviously wild to all-time high levels. And there is no doubt whatsoever that some of the Magnificent Seven stocks do not deserve these lofty valuations. And I am looking at you, particularly Tesla. But with all due respect, Palantir has a P/E ratio of nearly 500. It now trades 500 times its earnings. It is insane. And happily, this is not the case for the other big technology names out there. The others also trade with relatively high PE ratios, mind you. The average PE ratio for Magnificent Seven stocks is now past 30 versus around 20 for the S&P 493. Google's PE ratio, for example, is 32, Microsoft's is 36, and Nvidia's PE ratio hits 60, but it will likely level out when it releases its earnings later this earnings season. And Jensen Huang already hinted that there will be 500 billion US dollars flowing in from Blackwell and Ribbon chip sales between this year and next year. Again, a correction would obviously be only healthy given the speed at which the stock market pushed higher since the April dip. But I don't expect a dot-com bubble like a bubble burst when companies, the big technology companies, do print such a strong growth and they actually bring in massive income. Then there are the smaller and buzzier names. They actually could get a fatal hit from a market sell-off, yes, but the technology behemoths again have all the reasons and all the means in their hands to survive a probable market sell-off from here. Voila, that is the broad market thought about what's going on in the markets right now. Now, coming back to the earnings story. AMD released its earnings after the bell yesterday, and the company also bumped into the unpleasant negative reaction to a set of strong and stronger than expected revenue and earnings. In numbers, its revenue rose 32% to 7.69 billion US dollars last quarter, and the company projected that its sales will hit 9.9 billion US dollars this quarter. Alas, the share price fell 3.70% in the after hours trading simply because investors thought that all the good news were already mostly priced in. Now, the good news is that Nasdaq futures are less severely hit this morning at the time I'm talking here, hinting that the downside pressure could ease from today. But it might take more than a few earnings beats to bring the bulls back to this market. Now, in the metals and currency space. Gold, interestingly, doesn't pick up the risk-off trades. It, on the contrary, acts like a risk-on asset right now, falling in tandem with equities and other risk assets. The yellow metal just struggles to hold ground near the $4,000 per ounce psychological mark this morning. It probably went too fast and too high for bringing in the risk-averse investors. Bitcoin, on the other hand, is nowhere to be found as a safety net right now. The coin is now testing the $100,000 psychological support to the downside. Then the US dollar, on the other hand, is having a good week. Again, it recovers against most majors and acting like a safe haven asset after months of heavy selling here. The euro dollar, as a reaction, just slipped below the 115 level yesterday. Cable is getting ready to test the 130 psychological support to the downside into Thursday's Bank of England meeting, while the Aussie dollar is now back below the 65 cents level, despite a cautious statement from the Reserve Bank of Australia earlier this week, which actually refrained to cut the interest rates, pointing at looming inflation risk there. And all this is not surprising, as the US dollar was so crowded with short positions so far this year that the correction comes as a healthy and understandable move. But in all this chorus, the Japanese yen stood out yesterday, as Japan's finance minister said that he was not enchanted by the rapid depreciation of the Japanese yen lately, encouraging some speculative short positions against the Japanese yen to simply close their positions probably prematurely to avoid being caught in the opposite direction. But given the dollar's strengthening positive momentum these days and the dovish shift in the Bank of Japan expectations, the dollar yen will more likely than not amass courageous dip buyers in the coming weeks. Today, services PMI figures will be in focus on both sides of the Atlantic Ocean, along with some big company earnings, including McDonald's, Qualcomm, and ARM Holdings. So let's see how these companies performed last quarter, and more importantly, how investors will react. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.